On a Sunday in July 2026, 6 ships passed through the Strait of Hormuz. Before this war began, around 130 vessels moved through that waterway every day. Most of that oil was going to Asia. According to the United States Energy Information Administration, 84% of the crude oil that crossed Hormuz in 2024 ended up there. 4 countries, China, India, Japan and South Korea, took 69% of it. So this is not only a story about a war in the Middle East. When this passage closes, the place that shakes hardest is Asia, thousands of kilometers away. Today, we are going to follow the order in which that shock arrives. There are 4 stages: the price of fuel, the electricity bill, the raw materials that factories run on, and finally, the price of food. Start with the map. At its narrowest, the Strait of Hormuz is about 33 kilometers wide. The lane ships actually use is narrower still, roughly 3 kilometers in each direction. Iran lies on one side, Oman on the other. What matters is what sits inside that narrow door. Saudi Arabia, the United Arab Emirates, Kuwait, Iraq, Qatar. Some of the largest oil and gas exporters on Earth are all enclosed behind it. In 2024, 20 million barrels of oil a day pass through. That is about 1/5 of everything the world consumes in a day, and more than a quarter of all the oil that travels by sea. So why not simply go around? There are 2 bypass pipelines. Saudi Arabia can send roughly 5 million barrels a day west to the Red Sea port of Yanbu. The Emirates can move between 1.5 and 1.8 million barrels a day to Fujairah, but those pipelines are already in use. Counting only the space left in them, spare capacity is somewhere between 3.5 and 5.5 million barrels a day. Against 20 million, that covers barely a quarter. The rest has nowhere to go. And for Qatar's liquefied natural gas, there is no bypass at all. The gas is chilled to almost minus 160 degrees and loaded onto ships. If the ships cannot sail, that is the end of it. Here is what happened. On the 28th of February 2026, after the United States and Israel struck Iran, traffic through the strait effectively stopped. In early March, Iran declared the waterway closed, and the United States answered with a naval blockade of Iran. It did open, briefly. In mid-June, the 2 sides signed a memorandum to reopen the strait, and tanker traffic began to recover. The Energy Information Administration built its early July forecast on that assumption. The agreement lasted days. Fighting resumed in early July and traffic collapsed again. In the week to the 20th of July, crossings through the strait fell by 2/3. On the 16th, 8 ships went through in a single day, back to where it had been before the deal. So across 5 months, this waterway has been closed, briefly open, and closed again. That matters for everything that follows, because most of the numbers you are about to hear were calculated on the assumption that the strait reopens soon. That assumption has already been wrong more than once. The first bill is the price of oil. Middle Eastern producers shut in as much as 11.2 million barrels a day in May, according to the Energy Information Administration. In June, it was still 8.3 million. Oil stocks across the developed economies fell to their lowest level since 2003. And then something strange happens. Prices did not rise as much as expected. Through July, with 1/5 of the world's oil route still blocked, Brent crude has mostly traded in the 80s and 90s, well below the $105 a barrel the Energy Information Administration had forecast. The reason is not a good one. Asian oil consumption fell first. The Energy Information Administration expects the world to burn 1 million barrels a day less than it did last year, and it points to Asia as the main source of that decline. Some of that is careful use because fuel is expensive. More of it is demand that simply could not be afforded. When a shock is absorbed by volume instead of by price, it means economic activity itself has shrunk. A calm oil price, in this case, is the worst signal. The second bill arrives as electricity. Qatar supplies about 1/5 of the world's liquefied natural gas. 83% of the gas that crossed Hormuz went to Asia, and China, India, and South Korea alone received 52% of it. On the 2nd of March, Qatar Energy announced it had halted liquefied natural gas production after attacks on its facilities at Ras Laffan and Mesaieed. The spot price of gas delivered into Northeast Asia is tracked by an index called JKM. On the day of the attacks, it jumped almost 40% to $15 per million British thermal units. By March, the monthly average was 18, the highest in 3 years. The measure of how violently that price was swinging climbed to nearly 300%. But the more important part came next. When the strait briefly opened in June, the gas did not come back. The plants were damaged. Qatar Energy extended its notice that it cannot meet contracted volumes into September. An open sea lane is no use until the factory is repaired. This stage of the shock outlasts the blockade itself, and the countries that bought gas on the open market rather than under long-term contracts, Pakistan and Bangladesh among them, had to outbid everyone else for it. Pakistan paid more for a single cargo than it had in 4 years, and Qatar halved what it had promised Bangladesh for the year. The third stage is harder to see, and it is probably the one that hurts most. There is a substance called naphtha. It comes out of the oil refining process, and it is where the plastic and the synthetic fabric around you begins. Asia's petrochemical plants import 60 to 70% of their naphtha from the Middle East. Japan buys in more than half of what it needs, and over 70% of that comes from the Gulf. For South Korea, it is about half. As the blockade passed its first month, the price of naphtha shipped into Asia had already risen 60%. LG Chem shut down one of its naphtha crackers at Yeosu. Crude oil can be bought elsewhere. Naphtha cannot. There is essentially no other region that can supply it at that volume. So this shock shows up not at the petrol station, but on the factory floor. Plastics, textiles, paint, adhesives. The cost of the things Asia supplies to the world goes up all at once. The last bill takes longer to arrive. The Middle East accounts for about a quarter of the world's urea exports. Urea is the core ingredient of nitrogen fertilizer, and it is made from natural gas. When the gas stops, the fertilizer stops. Since late February, an estimated 3.9 million tons of Middle Eastern urea exports have been suspended. That is 30% of what the Gulf states ship in a year. Iran halted ammonia production, and Qatar stopped making urea and ammonia after its facilities were damaged. Prices went from around $400 a ton to above $850 in April, then back down to $453 in June. The World Bank expects urea to average roughly 60% higher across this year. India is in the most difficult position. All 32 of its ammonia and urea plants run on natural gas, and about 44% of the liquefied natural gas India imports comes from Qatar. The summer planting season was covered by stock already on hand. The winter season is not yet secure. A fertilizer shortage does not reduce this year's harvest. It reduces the next one. That is why an energy crisis reaches the dinner table several months late. Put the 4 stages together, and the numbers look like this. In July, the International Monetary Fund cut its forecast for global growth this year again, to 3%. Japan is at 0.6, China at 4.6. Global inflation is expected to reach 4.7% this year, and 3.9% next year. This puts Asia's central banks in an awkward position. When growth weakens, you cut interest rates. But cutting rates pushes your currency down, and a weaker currency means paying more for the same barrel of oil. That is why a shock that starts in an oil-producing country lands twice on the countries that import it. Not everyone lost. Iran could not sell its own oil during the blockade, and its neighbors inside the same Gulf lost their export route along with it. The gains went to producers outside it. As Asian buyers went looking for other suppliers, Russian crude stopped being the discount barrel, having been marked down by as much as $10 a barrel over the winter. It was selling at a premium of $7 to $8 over Brent by April and May. The same happened across the Atlantic. The International Energy Agency counted an increase of 3.5 million barrels a day in crude exports from the United States, Brazil, Canada, Kazakhstan, and Venezuela since February, most of it heading to Asia. So the largest thing this crisis leaves behind may not be the oil price. It may be that Asia's energy supply lines have shifted away from the Middle East towards the Americas and Russia. The strait will open again. It already did, briefly, in June. But supply contracts, once moved, do not easily move back. And one thing does not change. Asia cannot control this waterway. The only thing it can change is how much it depends on it. Thank you for watching.